Oh, thank you. Thank you, Laura, for that introduction. And we are back. My name is Scott Marcus, and I'm joined by my partner, Elana Polashuk. Say hi. And we have the, we are happy to present today with Ken Chong of HighTech Landing. And Ken, say hello. He's a friend of ours.
Hey, everybody. How's everyone doing out there? Thanks for having me.
Wonderful. It's always tough playing to an audience that you do not see or cannot hear, right? So it's similar to doing like bad comedy. You say, you throw out a joke and silence, crickets. But there are numerous people that are listening to us and right now that have joined, and also these webinars or Zoominars will last. They'll be up on YouTube and on various social media and snippets. So just a little bit about Ken. Ken's originally from Malaysia. He now is a resident of Parkland, Florida, which is where I live. He's been in the lending business for the short time of 20 plus years. So much like me, he's almost a lifer in the real estate realm. Ken, I like to always kick us off a little bit. Just tell me how rates are right now as of today. What are interest rates looking like?
As of today, assuming you're the ideal client with 740 plus credit score, you're probably looking at like 3.25 to 3.125. Depending on the time we lock, because rates have been quite volatile as of late.
Sure.
Sometimes with one rate change a day, sometimes with 3 to 4. So it all depends on the market. That's pretty much my job, is to watch the market and give you advice of when to go ahead and lock it in.
Yeah, and I purchased my home. I want to say end of December. And by the way, a plug for Ken at HighTech Landing. He's remarkable. He's systematic in his approach. He's organized. It's very digital, and he will just walk you through the process after a phone call. My rate was incredible. It was 2.625. So I'm very pleased with that. You mentioned something, Ken. You mentioned that, tier 1 credit, that's the best credit, correct?
Correct. Yeah. Tier 1 credit's basically 740 plus.
740 plus. And what would how does credit work? It goes down in tiers?
Yeah, it's based on tiers of 20 points. Okay. So the next tier down, tier 2 would be 720 to 739. Okay. Tier 3, 700 to 719, and so forth, all the way down to 620.
Okay. And so I wanted to familiarize those that might be out there with that, there are tiers to credit. Obviously, your credit score is probably one of the most important aspects of getting a loan. What are points, Ken? Because we hear about points a lot.
Basically what points are, it's additional fees charged by the lender to buy down your rate. Okay, so for example, typically, if you pay 1 point, which is equivalent to 1% of your loan amount, would be charged on top of your closing costs to bring down your rate by roughly 0.25%. So for example, let's just say today's rate's at 3.25. You pay 1 point. You go from 3.25 to 3%. And let's just assume loan amount's $300,000. So 1% of that would be $3,000, okay, to save 0.25% on your interest rate. Now, just to kind of add to that, do I recommend my clients pay points? I normally recommend them not to. Only reason is when you 1 point saving 0.25%, your break-even point's roughly 7 years, give or take. So, and most people, they're in and out of their house within 5 to 6. So you're never going to recoup unless you really feel like you're going to be in the house for the next 30 years. Then that would make sense to pay the points.
Well, that's so well said, Ken. And I want to reiterate for our real estate agents that are listening that you know, 1/4% is a fractional amount of a mortgage payment. Multiply that by 12, you know, that's what that 1/4% would be saving you for the year. And like you said, if you're paying $3,000 and you're really saving $100 or $70 a month or $50 a month, you know, you have to do the math in order to determine whether or not that that savings is necessary, or paying that point is necessary. So did you just join again, Ken, through another mode?
No, I shouldn't have.
Okay, well, that's okay. There's but that's another Ken on mute, but that's you. Maybe through your iPhone. So let's talk a little bit about types of lenders. All right, you've got your standard, you've got your Wells Fargo and your Bank of America. You've got what you are, which is a direct lender / mortgage broker. Okay. And then you've got just a straight mortgage broker. Could we talk a little bit about what those three are?
Sure, absolutely. I mean, yeah, typically, there's always the big banks, okay, Bank of America, Wells Fargo, and Chase. Now, I mean, I think as far as the industries involved, I don't think they've created such a great name for themselves. I think a lot of it has to do with they're just too big. So
yeah,
you're constantly talking to other people, different people in the whole process, which in my opinion, if you can talk to just one person throughout the whole process, I think it makes the stress level a lot less, especially for a first-time home buyer. So that's why people like myself and people, that are just, all they do is just mortgages versus some of these big banks, they tend to do well and have a better response from the public, because all you're doing is just talking to me. You're not going to talk to down the line, kind of like a factory line or
right,
whatnot. And then, so then once you go into getting a loan through a mortgage specialist, like a direct lender or a mortgage broker or whatnot, which is all they do. The main difference is, as a direct lender, everything is in-house, okay? Meaning we underwrite the loans in-house, we fund the loans, and we sell the loans, okay? Versus a mortgage broker. A mortgage broker, they're brokering it out. They're contacting a bank and shopping your rates around or whatnot. And whichever bank they decide to put you through, they're going to act as a broker, meaning they don't quite have a relationship, okay, with the bank that's funding your loan. Okay. Now, why is that important is that as a direct lender, if we don't close your loan, we don't get paid, and we need money for operations. So we're going to do everything in our power to get you closed. Okay. Where as a mortgage broker, they're gonna scrutinize your loan a little bit more. That's why in most cases, mortgage brokers, they take a little bit longer to close, and they have a lot more conditions once it comes out of underwriting. And sometimes your loan officer, as a mortgage broker, has a hard time getting conditions clarified when there's something a little bit difficult or whatnot. Whereas a direct lender, I just call my underwriter directly because we have a relationship, and we're going to do whatever we need to do to get you closed and as quick as possible, because right. Our job is to, as quick as you come in, we want to get you out as quick as possible.
So Ken, you're not reliant on somebody else's funds. You're utilizing your own funds to fund the loan, correct?
Correct.
Mm-hmm. Okay. And, you do broker loans too, excuse me, in some cases.
Correct.
Yeah, the loan would be maybe a little bit non-conforming or out of the standard box. So you would broker that loan just like, a regular mortgage broker would, but you still, and I've seen you do this multiple times, the way you handhold and walk the parties through, especially the borrower, through the process. It's not like they call up a 1-800 number and they go into some kind of rotary, press 1 for no one. So you're there, you're reachable, you're textable, you're emailable. So yeah.
Absolutely. I mean, I truly believe that, I don't like to pass the client to, let's say, a processor or whatnot. I want to do all the talking. So this way, there's no miscommunications with the client. And, I'm always reachable, whether it's text, email, or phone. Again, I understand that this is probably the biggest investment most people are going to make is buying a house, and they get nervous.
Yeah.
So I want to make sure I'm there for them. And I guess that's, I think service is key in the lending side.
Well, let's talk a little bit about pre-qualifying a buyer. There are different terms and there are different documents that are utilized out there, Ken. And, at this point in such a hot seller's market, if I'm a seller, I am not taking my property off the market for anybody unless I know that those people can close. And there are different types. There's a pre-qualification, right, of a buyer. There's desktop underwriting. Let's talk a little bit about what the difference between those two are.
Okay, so I mean, a pre-qualification letters, in some cases is pretty much like a generic letter that states, to whom may concern, John Doe is pre-approved for XYZ loan amount. And that's basically it. Maybe a couple other sentences in there to fluff up the letter, which I think, in my opinion, a lot more realtors are requiring DU approvals these days because they understand what's required in order to get a DU approval. Okay,
DU
a DU approval.
Desktop underwriting.
Correct, a desktop underwriting approval. Okay, because in order for me to issue a desktop underwriter approval, I have to, one, run their credit. So that credit's been run. We know that their score meets the guidelines. Okay, and I check their credit. Their income, their assets. Okay, and we calculate their debt to income ratios first based on what they make, what's on their liabilities. We run it through an approval system, and it will either state approve eligible, which basically means he's approved based on his information, or they'll say refer with caution, basically meaning they don't qualify based on the guidelines. Okay, so once a listing agent receives a DU approval versus, let's just say, a generic pre-qual letter, they're gonna feel more confident that this person's gonna close. Now, especially if they know how to read one, that's something we can probably discuss in the future, how to read a DU approval. But, for those that know how, they can look at the debt to income ratios, see if they're high, they're low. They can look at the assets that's been inputted, see if they have any reserves, just in case, especially in today's market, if they need to go up an extra 5,000 above appraised value or whatnot, are they going to have enough money left? Sure. So, if you know how to read one, it's definitely a great tool to have, especially on the listing side.
Okay. No, that's great. So our agents really need to be on the lookout for the appropriate type of letter. Just because a buyer comes to you with a letter and it says pre-approved for, this much, it does not mean that the buyer has been vetted with their credit score or their documents. So you're really looking for that desktop underwriting. I like that. That's a great tidbit.
Yes.
One of the things that I want to talk about, and you mentioned yesterday during our pre-discussion, is something called overlays. And even if a loan is approved or underwritten, there are potential overlays, right? Which are coming from the investor, such as a COVID overlay.
Correct.
Okay.
Yeah. So basically, what overlays is, in addition to what Fannie Mae or Freddie Mac allows, coming from a conventional loan side, that particular lender or investor, may have other conditions on top of that. That's what an overlay is. Okay. So, for example, let's just say minimum credit scores at 620 with a Fannie Mae loan. And that particular investor, because due to COVID, they don't want to expose themselves to a higher risk loan, they may have an overlay of, well, we're only taking loans that are minimum credit score 640. So that's considered an overlay. Even though Fannie Mae allows you to go to 620, they require at least a 640 credit.
Gotcha.
And I mean, a lot of lenders did do that once when COVID started, but at this point, a lot of them have relaxed and gotten rid of a lot of the overlays. So which is good for potential buyers moving forward.
No, that's good. And did you have something, Elana? Because
yeah. So what overlays are still in place for COVID for for most of the lenders and investors that you're working with?
I mean, some of the overlays that are still pretty prevalent is FHA does allow down to 580 credit score. Some of our investors are only taking a minimum of 620 credit. Okay, and then the ones that will take a 580 credit score, the rate is definitely compensated by the rate. The rate's much higher than versus pre-COVID. So mainly it's right now mainly a credit score has been the overlay that's I've seen most prevalent as far as from an investor and lender standpoint. But everything else seems to be back to normal as far as assets, debt to income ratios, amount of reserves required depending on the program.
And are you still verifying income, verifying employment right before closing as well?
Correct. I mean, right now, I can't speak for other lenders, but as far as our prior to funding overlay for COVID is that we require the most recent pay stub, just one, not two. We have to verify they're still working for the company within 5 days, and they've signed what's called a financial status, basically stating that they understand there's COVID-19 going on, that they're financially sound, that they're not going to get this loan and request for a forbearance right away, that they can pay this loan.
Okay. You know what I wanted to do? Kind of run the viewers through almost a sample of a borrower. Let's just assume this borrower is your ideal borrower, tier 1 credit, and has a long-term existing job that they get W-2'd on. So that borrower gets introduced to you. Hey, call Ken Chong at HighTech Landing. They give you a call. What are the steps? Give me the phone call. Give me the steps. Give me the items you're asking for.
I mean, basically, when a client calls in looking to get pre-approved, I go over a couple very basic questions with them. First thing I like to find out if they're first-time home buyer. So depending on if they're first-time home buyer or not, then I can go through a little bit more of the P's and Q's as far as for first-time home buyers, because I understand that they don't know as much. Okay, and they've never been through this. So what I like to do is, instead of asking them what they're looking to buy as far as a purchase price, I do kind of more reverse. I ask them, what do you feel comfortable paying? And then based on what they feel comfortable paying, then we kind of make and how much they're going to put down, we'll tailor the loan amount based on that. Now, sometimes first-time home buyers, they're a little bit more conservative. So I do let them know that they can go a little bit higher if they'd like, okay, but the payment will be X, Y, Z. So once I kind of get to know their profile as far as first-time home buyer or not, the type of income, whether self-employed or W-2'd, we discuss some of the items needed, and I usually send them an email or text message with the list of items needed. They put the items together, scan it, email it to me. Once I get it, I'll fine-tune the pre-approval. And as soon as they find something, I always let their realtor know. Give me a call, give me the address and the offer price, shoot you over a deal approval specific to the transaction. And good luck, and hopefully you get the contract.
Yeah. And the items that you mentioned, just so that we all understand, because you're so familiar with it, you do it, but in your typical loan, what are we talking about? 2 years, last 2 years W-2s, right?
Correct.
Last 2 years tax returns.
Correct.
Most recent 30-day pay stub.
Yep.
And how many months bank statements?
2 months bank statements and copy of the driver's license.
And a driver's license. So that's it. So, and I'll say this, that if an agent is spending their time with a buyer, it is very wise to have the buyer vetted by somebody like Ken to determine what that buyer can buy before you start driving that buyer around or meeting that buyer at these multiple locations and showing properties, because you want to make sure that there's not a horrible ding on their credit and that the buyer can afford what the buyer's, so it's actually, before you spend your time, because your time is really not an endless commodity, it's finite. So before you spend your time driving around with buyers, you want to have them properly vetted. Isn't that correct, Ken? Do people call you for that?
Yes, I 100% agree. Most agents do that. Now, however, there are also agents that show the clients, the buyers, properties before getting pre-approved. And in my opinion, I think that's a big mistake for obvious reasons. You don't know if the buyer's approved or not, for one. Okay, and secondly, which I've seen happen, where let's just say they're looking for a $500,000 house. They haven't been pre-approved. They find a property. They come to me then to be pre-approved, and they learn that they only qualify for $400,000. Mm-hmm. Now, if you're showing $500,000 houses for the last 30 days, and then all of a sudden now you have to show $400,000 houses, that's a detriment, because there's a difference in what you see at 500,000 versus 400. Sure. And then you could potentially lose the buyer, because in their minds, they want what they see for 500,000, but they can only afford 400. It's
tough to go backwards.
Yeah, exactly.
It's really hard to go backwards.
Yeah, so it's really hard to go backwards, and I've seen that mistake happen many times, and I definitely constantly emphasize to real estate agents I work closely with, just make sure, let's get them pre-approved first before you start taking them out, because we don't want to run into any problems.
So that's great advice, Ken. Let's talk a little bit about the types of loans. We've got conventional, we've got FHA, and we've got VA, right?
Correct.
Okay. Conventional loan. That's just to walk me through that a little bit. What a conventional.
Your conventional loans, your typical Fannie Mae and Freddie Mac type loans, okay, where you can put as little as 3% down if you're a first-time home buyer, okay. Put 20% down, you have no mortgage insurance, okay. I always recommend, if you can do it, put the 20% down, because the mortgage insurance is depending on the price of the house, anywhere from $150 to $300 a month. That's just money being wasted. Now, then you have your FHA loans. Now, keep in mind, FHA loans are for primary residences only. Okay, so, and it allows you to put as little as 3.5% down, which a lot of first-time home buyers do go FHA, and lending guidelines on FHAs are a little bit looser versus conventional. Okay, then we have our VA loan, which is for veterans only. You have to have served in the military or currently serving. The beautiful thing about that loan is you can go 100% financing, no mortgage insurance. It's a great thing. Very loose debt to income ratios. So it's our way of taking care of our veterans.
So when we're comparing an offer, let's say we're a listing agent and we are receiving multiple offers, and somebody comes in with an FHA loan versus somebody with a conventional. The FHA is not necessarily, or it's not a lesser loan in terms of like the possibility of it actually closing. Might be lesser in terms of how much down you have to put, but in terms of actually closing, it shouldn't be frowned upon, correct? Unless there's a couple unlesses, and we'll go over those, but
Correct.
in most cases.
Correct. I'm so glad you brought that up, Scott, because there's a lot of myths out there versus FHA versus conventional. It's not a lesser loan than a conventional loan. Okay. Some of the myths out there that an FHA appraisal comes in lower than a conventional loan appraisal. That's not true either. I mean, if the house is worth 500 or 400,000, whatever it is, that's what it's worth. It doesn't really matter what type of loan you're going. And if they're approved for an FHA loan and you're going with an established lending company that has a proven track record, there's no reason why taking the FHA deal is not going to close. I think at the end of the day, as a listing agent, you want to get the best off the most amount of money for your seller. So if let's just say the FHA deal is a little bit higher and versus the conventional, why not take it?
Yeah.
And I would encourage, I think, the listing agent to find out who the lender is, give the lender a call, speak to them, get as much information as you can about the borrower before making a decision,
Right. And I think the areas that we might need to proceed cautiously as a listing agent is if your listing is in a condominium, because condos could be not FHA approved, and therefore it's just, you're going to be really, the inevitable is going to happen where the lender is not going to lend because the condo is not approved, right?
Correct. So that's the one negative about FHA is that they require the condo to be FHA approved, which unfortunately down here in South Florida, I would say 99% of condos are not FHA approved.
Sure. While we're talking about condos, and those that might know the Becker firm, we are the largest community association law firm in the world. We represent thousands and thousands of community associations, and there are different types. There's your standard homeowners association, which falls under one statute, 720. There's 718, which Ken was just talking about, which is condominium. And there's also cooperatives, which is a separate statute in and of itself. While we're sticking on condos, I think, Ken, during our pre-interview, we were talking about some really, really great points for when an agent is showing their buyer condos. You told me one of the first things that agent should request is what?
Definitely the condo budget.
Budget. Okay.
Because unless the borrower is putting 25% down, you definitely want to get a hold of that condo budget, because that's usually the kiss of death when it comes to getting a condo questionnaire filled out. Mm-hmm. Because whenever you buy a condo, all lenders will, most lenders, will require what's called a condo questionnaire filled out. Yeah. And there's two types. There's called a limited review, where you put 25% down or more, or a full condo review, which is less than 25% down. Now, in the big difference is that the full review obviously requires, there's more questions asked. There's more of a chance of the condo, not so much the borrower, being denied based on the characteristics. Now, the kiss of death is normally the amount of reserves allocated. Okay, so what they're going to require on a full review is at least 10% of the maintenance fees are allocated towards reserves. So
Okay.
meaning, let's just say it
And
cost.
that's important because a condominium and a homeowners association, it's a company. And like any company, it's a business. Now, it's not a for-profit business, but it's got money coming in through assessments. If they are lacking money, they don't have reserves, capital built up, and they need to do a mass scale project, they might have to special assess, which means assess all the unit owners equally to do, let's say, the roofs or the pavement or the pool deck. And what Ken, you're saying is if the reserves, if there is not a 10% amount in the coffers of the association, of the condo, then we start having to look at that buyer and that buyer's down payment a little bit differently, right? 25% or over, they're fine. Under 25%
Correct.
and no 10% reserves, not so fine. So don't waste your time as a buyer's agent without knowing what that condominium's budget looks like.
Correct. Now, just to clarify, now the 10% reserves is not what they're currently holding. Okay. It's 10% of the maintenance fees collected that's allocated to reserves.
Okay, good.
So I just want to clarify.
Thank you for correcting that, for correcting me. 10% of the maintenance fees allocated are for reserves. Okay, gotcha. Okay, well, that makes sense. So, and you know, if the agents or the buyers have trouble looking at a condominium budget, they can always call you. You can look at it. You've seen one or two or 1,000 of them before, so you can help with that. What else in condominiums? I know pending litigation sometimes hangs up a deal, and it depends, right, Ken?
The pending litigation, I'm glad you brought that up as well, is not necessarily 100% a deal killer. Okay. The pending litigations, let's just say if it's something small, okay, for example, I just had a condo questionnaire come back where they had a pending litigation where it was a high-rise building. The building next to it was getting built. While they're painting, the wind blew some of the paint onto the wall of the subject property. And, you know, they're suing them to fix it. That's it. I mean, it's no big deal. So with something like that, we'll do those pending litigations all day long. Now, the pending litigations that, you know, that Fannie and Freddie won't take is, let's just say if there's some sort of structural problem where the HOA is suing the builder that built the building or whatnot, then that's going to be a problem. That's going to be a deal killer.
Got it. Okay. One of the things that I want you to go over is some classic mistakes that buyers make or borrowers make after they've applied for a loan and they're on their way through the process of home buying. And I remember you said something to me. So, you know, this isn't like something that only should fall on the ears of the first-time buyer. I've bought many places, but Ken said something to me during my process after. He goes, "Scotty, you're approved." He goes, "Now don't go out and start opening up credit lines to buy furniture." You know, like, because we'll go to City Furniture and start ordering things on a 24-month no interest. They're pulling credit. They're opening up a credit card. And it's going to affect your score, and it's going to potentially cause problems, right, Ken?
Absolutely, 100%. Okay. Because keep in mind, like we spoke earlier, that your rate is credit score driven. So let's just say when I initially pulled your credit, you're at 750 or whatnot, tier 1. Then all of a sudden, you know, they re-pull credit, you drop to, let's say, 700. Oh my! Then you dropped from tier 1 to tier 3. And your rate's going to change. You're not going to be happy about that. So I definitely, you know, always warn the borrower, look, whether they know it or not, once I've run your credit. Please do not go out there applying for credit. Do not buy new cars. Don't start putting stuff on credit. I know you're excited about your new house and you're going to start furniture shopping, maybe make the list. And once you close, go at it, go do what you got to do, but not during the process.
Gotcha. So, no, that's excellent. I mean, so right there, two extremely valuable time-saving tips for a buyer's agent working with a buyer looking at condominium units. Grab a budget first. Let's not look at 10 units in a building before we know. And if this buyer is only going to put 3% or 5% down or 10% down, let's be maniacal about that budget and determine if this is a place for them, because we don't want to get to the end of the process once the questionnaire is filled out and then determine, oh, this place is not going to be suitable for this buyer with their down payment. And the other thing is, buyer, don't screw yourself up by doing something before closing, but after the first approval process. So I think that's invaluable. It brings me to a topic of the team, and you and we work together. We work with some amazing real estate agents. I mean, the importance through your 20-year career, the importance, Ken, of a team and relying on the other team members is just invaluable, right? You need title, you need loan.
Of course, I 110% agree on that, because in what we do, it's not a one-person thing. You have your, in addition to being a realtor, you have to have a great lender that's always going to be there, and answer your questions, make sure your deals close, try to keep the deal as smooth as possible. And you got to have a great title company as well too, because they're the ones that's going to be closing the deal for you. I've experienced some deals where the title company, wait till a week before to order lien searches and estoppel, and we're ready to close and they're not. So, and especially one thing I have to emphasize is, some title companies don't have attorneys on board, and I've done various deals with Scott where we needed his expertise in order to move the deal along. He jumps in when people hear this is attorney Scott Marcus, they tend to move a little quicker. So I love that about working with Scott, is that when we need him to jump in, he can, and make the deal go through a little bit quicker and smoother, because my job is to make sure that the realtor is not constantly wondering what's going on in the loan process. I want my realtors to, do what they do best, work with buyers, work with sellers. If they tie up their time constantly calling the lender to find out what's going on, that's not really what they should be doing. I want
not a
them
valuable
Exactly.
use of time.
Correct.
And you bring up a good point. With regard to the legal aspects, and Elana and I like to kind of infuse the legal aspects into each of these discussions. We had one on FERPTA, we talked about contractual provisions, but the legal aspects of what we're talking about today with the loan is really the whole ballgame, as far as I'm concerned, in the contract. It's Section 8, and it's the loan approval process and the loan approval period, and it's what a buyer needs to do by when. And if one of the takeaways that I would like for the agents to take away is that the contract is time sensitive. There are deadlines. There is a period of time called a loan approval period. Within that period of time, you have to, as a buyer, do something affirmative. You have to either give notice that your loan is approved, or if you're having trouble getting your loan approved, you have to extend the time frame with the seller to get that approval. Or if you're not going to get an extension and your loan is really teeter-tottering and it's not a certainty, then you need to terminate. but you have to do so within the time frame of the contract from which you're given. And I've seen too many occasions where we're past the loan approval period. And by the way, in the current version of the contract, within 3 days of the expiration of the loan approval period, if that buyer does nothing, i.e. does not give a notice or waive the loan approval, does not give notice of the loan approval or waive it or extend, and that seller, so I call that, that the buyer just falls asleep, and then seller decides, hold on now, I've got 15 new offers and they're all coming in higher than this buyer's offer. That seller could send a termination notice, because that seller has a contractual right to terminate the contract if the buyer does not give notice of approval. So that's a very important tidbit. And we're in the process, for some that might know, I'm one of the attorneys that drafts the FAR contract. I probably spent dozens and dozens of hours this go around redrafting the financing section to make it more user-friendly, more even-keeled for the borrower. And right now, one of the aspects that falls outside of the financing or the loan approval period is the appraisal. So literally an appraisal could come the day of closing, and if it doesn't appraise, that buyer or borrower still has some abilities to get out. And that's a very unfair provision if you're representing a seller. So we're doing some things on this next go around, Ken, that are going to tighten up the defined terms in the loan approval section, in the financing section. But from a contractual standpoint, agents pay attention to your deadlines, and especially your loan approval deadline. Right, Elana?
Yep, and also the contract, all it requires for loan approval is notice. It does not require a buyer to deliver a loan commitment letter, because those are typically conditioned on various items that the buyers still have to complete. And once they get in the hands of sellers, especially in this market when they have other offers, then they start to pick at it, and it's never good.
and Elana, we've seen this before, but a very, let's say a newer agent who might be a little bit overzealous and happy that their buyer received a piece of paper from the lender saying loan approval, and before reading it, they send it to the other side. And really what that does is it waives the buyer's rights per contract. And now the buyer is not subject to getting to closing on this contract subject to all their conditions. They now no longer have a contract that's conditioned on financing, because you've just given notice of loan approval. And the contract does not read notice of loan approval without conditions. It just says notice of loan approval. So as an agent, you never want to give that notice to the other side without consulting with your buyer, having your buyers buy in and saying, yes, you may share, and I am confident I'm going to get my loan. Huddle with the lender and the buyer agent together before that notice is given. Right, Elana?
Exactly.
Okay. All right. Well, Ken, is there anything else? I know we're at the 45-minute mark. We usually like to keep it right about here, because you know why? My attention span starts to wane at 45 minutes. So anything else going out that you feel is important, or did we cover a good overview?
I think I think we've covered a good overview. I mean, obviously, we're going through kind of like the basics of on the lending side. And I mean, all I can really say to our audience out there is, again, it's very important to have a lender that's knowledgeable and knows what they're doing, because unfortunately, a lot of the deals that go sour, it's due to the buyer not being able to get any financing, and the financing falling through the last minute. Because I hate doing it, because it puts me under the gun, but I've had to save a lot of deals, unfortunately.
Sure.
And, it's never fun to have to close a deal in 2 weeks, but, we get it done. But I would rather not. I just rather, the realtors educate their buyers, to make sure they go to a lender that's reputable and know what they're doing. So they don't have to go through that stress. It's not a fun thing, especially for a first-time home buyer. So
yeah, I couldn't agree more. And, look, every buyer they have the right to choose their own lender, but a lot of buyers need to be held by the hand because they don't do this they obviously don't do this as often as we do. And just because they feel they have a relationship with a bank does not mean that that bank is going to be the best forum for which they get their financing. So I think it's valuable for an agent to encourage their buyer, regardless of the buyer's relationship with whomever, to check with somebody like Ken at HighTech Lending, and we'll share all your contact information, Ken. But to really get that buyer, even if a buyer, and I know if a buyer speaks with you and gets comfortable with you, they'll go with you because you have a way of making the things that are difficult to understand, making them easy to understand. So you're a lot like a teacher, and you're very organized. So it's very, you make the process easy. So yeah, it's important for these agents. You work so hard out there. It's, why not spend the time getting your buyer in front of a good team member? So that's the gist of the lending discussion for today. Anything going out, Elana, that
I 100% agree on, hiring, expert professionals across all avenues, title, lenders, realtors as well. And the communication throughout the transaction really is key to a successful closing as well.
Perfect. Well, with that, we're wrapped up, and thank you all for attending. And thank you, Ken, for spending your time as the masterclass guest of the day.
No problem. Thank you for inviting me.
All right. Awesome. Bye-bye.
Thanks.